Welcome to the 3-Edge Week in Review for the week of October 20th. I'm Fritz, Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, the CEO and Chief Investment Officer here at 3-Edge Asset Management. Now today, Steve and I will be covering the ongoing discussions about what many are referring to as the AI bubble. And we'll discuss what good can actually come from economic and market bubbles. What are some of the facts surrounding the current bubble in AI? And of course, we'll cover what can be bad about bubbles that come along every so often throughout history and how investors might protect their investment portfolios from the potential bursting of the AI bubble. So we have a lot to cover, and let's get started. So Steve, it certainly does seem as though at this point everybody is talking about this AI bubble. And so, although it might seem counterintuitive, maybe you could start us off by talking about what could actually be good about market bubbles.
Well, Fritz, we've had bubbles throughout history, and these have all revolved around technology revolutions of one kind or another. Back in the 1800s, we had the tremendous new technology called railroads. And because we had a bubble and we had tremendous bullish narratives drawing people into the market, so much capital came into the market that railroads were able to expand all over the country to the benefit of society. Now, most of that early money overshot in the stock market and then crashed, and most of those people lost money. But if it wasn't for the tremendously bullish narrative and all the excitement, all the money going in, we wouldn't have had the kind of railroad implementation that benefited society. Then in the 1920s, we had the Roaring '20s. We had new technology bubbles: electricity, automobiles, mass production, radio and communications. These are all tremendously exciting technologies, drew lots of capital in, overshot to the upside. And then even though a lot of those companies went bankrupt and a lot of people lost money in the crash of '29, the Great Depression, if it wasn't for all that capital investment, we wouldn't have had those great technologies benefit society ever since. Similarly with the internet, we had lots of excitement around the internet, tremendous amount of capital came in, built out the internet, so it's been so useful ever since. But a lot of those companies went bankrupt, and a lot of that early money ended up going way up and then way down in the market. And now we have the AI bubble, tremendous excitement, a new technology revolution, lots of capital coming in, both equity and debt coming in to building up the AI infrastructure. No doubt it'll have tremendous benefits for society for years, we all hope. But a lot of that early money will overshoot to the upside like the other technology bubbles. And then a lot of the early pioneers might lose a lot of money, but society will benefit. Now, let me ask you a question. I know you've been researching the AI bubble, and you have some interesting facts to share.
Sure. So, some of the more obvious signs that we see that could indicate we're in a bubble here is the fact that, we have an enormous degree, and we've talked about these before, we have an enormous degree of stock market concentration around a handful of these mega cap tech stocks. We have the Mag 7, for example. And this has also meant that a large percentage of the gains in the U.S. equity indices, such as the S&P, they've come from just a handful of companies. And as we've discussed, valuations of the S&P 500, for example, driven by these handful of companies, have risen to just extreme levels. And I know that you refer to this a lot, how on a price-to-sales basis, the valuation of the S&P is higher now than before the tech stock bubble and burst, as investor enthusiasm in the bubbles you mentioned before gets well ahead of itself at this point. I also have one other factor that I think is interesting, and something that also occurred during the tech bubble, and that is that we're seeing more and more of what is referred to as circular investments among these leading AI companies. And circular investing just simply refers to a situation where these AI companies invest in one another while simultaneously becoming each other's customers and suppliers. So here's a couple examples. We have NVIDIA has now pledged up to $100 billion to support OpenAI and their next generation of AI models. In return, OpenAI is buying massive quantities of NVIDIA's specialized computer chips. Another example is something referred to as the Stargate project, and this is a $500 billion initiative involving OpenAI, Oracle, and SoftBank to build AI infrastructure. And in this arrangement, the three companies basically play overlapping roles as investors, vendors, and clients in one another's firms. And the thing is, we also witnessed this trend leading up to the dot-com bubble of the late 90s, when we had technology startup companies investing in each other's IPOs, buying services from one another, and they were able to report inflated revenue based on these transactions and creating the illusion that they were growing. But as we know, the bubble burst and many of these companies collapsed. So those are a few examples of why we might be concerned about being in an AI bubble. So now time for you to answer the question, one, what is bad about these market bubbles? And two, what can investors do to protect themselves when the AI bubble should burst?
Well, there are a lot of investors that hope that history won't repeat itself, that this time is different, but those are dangerous words. And they've been mentioned at the top of every bubble and hasn't worked out. So unfortunately, there has never been a bubble that just leveled out at some high level or permanent plateau. There's always been, perhaps based on human nature, this idea of a melt up and an overshoot to the upside with all the excitement, and then a reversal or a correction or even a crash. So we have to expect that will happen again. Now, bubbles typically last far longer than what any fundamentals or logic might suggest. And so there's no guarantee that this correction is going to happen anytime soon. But the mathematics of a bubble are very similar to the mathematics behind and the physics behind an avalanche. Snow keeps piling up. The pile seems sustainable and it just gets bigger and bigger. And then what comes along is the one critical snowflake that lands on the pile that begins the avalanche. And it's hard to predict which snowflake that's going to be, but it makes a critical difference. And that seems to be the same as what brings stock market bubbles to a halt and then correction on the other side. So that's what we have to worry about. We look at all the warning signs of when that one critical snowflake might arrive. Now, at the beginning of a correction, because buy the dip psychology has worked so well over the last few years, often you will get, after the initial correction, you will get a rebound. And perhaps one clue that we can all look at as investors is if that rebound fails to exceed the previous high, that is a clue that maybe this is, finally the real correction, and people should take note and take caution. So to summarize our view on how that should affect investors when we're looking at a potential bubble, I would say, number one, investors should diversify beyond just overvalued U.S. stocks, because that's where the bubble might hurt the most. And one way to diversify is by including international stocks within your equity portion of your portfolio and not just relying on U.S. stocks. Also, given all the large and growing debt that governments are piling on and the increasingly tight credit spreads that seem to foresee that we'll never have another recession again to hurt the debt markets, we much favor hard assets over corporate and longer-term bonds. And then finally, if and when the correction does come, investors would be wise to have some dry powder with which to invest in much better pricing after a correction. And we recommend to do that with treasury bills and with tips.
Excellent. All right, good. Well, thanks, Steve. Thank you very much for that. We will be watching very closely in terms of the AI bubble and making sure that we are taking those steps necessary to protect our clients. So thank you for that. So that will do it for Steve and me for this week, but we will be back next week with another edition of the 3Edge Week in Review. As a reminder, all our videos are always available on our 3Edge YouTube channel. If you know someone you think might benefit from these, please feel free to share them. And if you enjoy our videos, please consider subscribing to our 3Edge YouTube channel, we'd be most appreciative. So, until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.